Welcome back to our Infinite Banking with series. This is by far one of the most popular questions we get is, I want to do infinite banking. What's the most popular insurance company that I should choose? And the answer is, it depends. We work with a lot of amazing insurance companies. And in this series, this is the most thorough series, taking every different insurance company you could work with around infinite banking and walking through all the pros, all the cons. In this series, we're going through the companies. We're going through their ratings. We're going through the lapse ratio. We're going through their track record. We're going through their view of infinite banking in general. Do they like infinite banking? Do they not like infinite banking? We're going to look at illustrations, the real numbers, cash flow design, front load design. We're looking at how loans work. We're also looking at the flexibility of PUA funding. That's something that not a lot of people talk about. Really important to our channel that we cover that. And there's so much more, man. And then we end with pros and cons, and I have even some key takeaways if you are a producer thinking about working with this insurance company. And so in this video, we're going to be looking at Guardian, and Guardian is a company that you may have heard of because they are a big company, and we are very, very excited to walk through this. Without further ado, I want to introduce Alden Armstrong, who is our head of product and case design, and he's the brains behind this presentation and this series. And Alden, you've done a phenomenal job. I've already very much enjoyed the series and just pumped for all the insurance companies to come. Stay tuned. This is going to be, again, the most thorough series on YouTube.
Amazing. Well, no pressure, but guys, we're going to be jumping into Guardian Life Insurance, like Caleb said. So let's get to it. Guardian. So high level, we need to know a little bit about the company. How long they've been around? Are they doing what they say they're going to be doing? Guardian's been around since 1860. They've had 157 years of dividend payments, and they are one of the big four. What does that mean? Well, the big four are the four largest mutual insurance companies in the United States. That is Guardian, Mass Mutual, New York Life, and Northwestern Mutual, in that order from bottom to top. So Guardian, they're a big company. They do really, really good business. An interesting fact about Guardian that actually has tripped me up in the past and other reviews I've done of this carrier is they were established as a stock company. And then in 1925, they changed to a mutual company. So my brain said, okay, well, they've been paying dividends since they became mutual in 1925. Actually, they were paying dividends as a stock company too. Very interesting history of this company, but they were kind of a stock hybrid until 1925 when they changed. So probably more than you wanted to know, but I geeked out over that, so I thought it was fun. All right, so diving into financial strengths and the performance. When it comes to comparing insurance companies, there are a couple of key metrics that we want to see. Yes, mutual. Yes, they've been around for a long time, but are they paying dividends? What's the amount of the dividend, right? And some of these other metrics on the screen. So first and foremost, Guardian is a big company. $1.6 billion of dividends declared for 2025 that will be distributed to policyholders. That's a lot of dollar signs. The next metric is the dividend interest rate. So right now it's about 6.1% projected for 2025 moving forward. And then this last metric, this is new to the channel. It's something Caleb mentioned in the intro, lapse ratio. In the insurance industry, lapsing an insurance policy just means it's going to be surrendered. So you take your money and you walk away. You take that to another carrier, or it lapses because the internal charges in the policy exceeded the cash available in the policy. So those three ways gives us a ratio, and this is a per year ratio. The industry average is just over 5% per year policies are lapsed. Guardian, their average is below that. It's about 3.3% average over the last 5 years. To me, this indicates strong policyholder satisfaction. So if we have carriers that are saying a lot of great things, the agents are saying great things, and they sell you a really cool policy, but then that person ends up leaving, that's indicative of a bad lapse rate, right? That product and that carrier is not doing what they said that they would do. So this is very, very good sign looking at Guardian. Guardian is a direct recognition carrier. Now, there are some options for non-direct recognition loans on certain whole life products once they're about 10 years old. But by and large, across the board, they are direct recognition initially, and there is some strength to that when we get into that next slide. Last I'll mention is the COMDEX score and the AM Best rating. COMDEX score, as you may know from our channel, it's a score out of 100, conglomerate across 6 different rating agencies. AM Best is one of them. So Guardian falls as a 99 out of 100. They are in the top 1% of insurance carriers for financial strength and stability, which is a pretty solid claim. AM Best rating agency, they have a A++ superior rating as well. So keep these ratings in mind as we do additional videos on other carriers moving forward. So guys, since we're talking about IBC, how does this actually interact with the carrier? What's the positioning of this insurance carrier and its product for this type of strategy. One thing I'll say up front is that Guardian is not really well known for IBC. They're well known as almost a white collar insurance company. Their disability insurance, their whole life insurance, their target market is high net worth and high income individuals. So in that context, they're not known for IBC. But as we'll see, their products are very conducive to having a good IBC style product with a lot of cash value. Their stance on IBC, I think, is important to note. They're not pro, but they're also not anti IBC. So they don't support IBC as a strategy, but their products maximize the potential to use for IBC. And this is important for a couple of reasons. When we're going to an insurance carrier to get an insurance policy, if we're trying to apply with a policy where they're putting in a lot of money in the very first year, like a front load, that doesn't typically fit the traditional financial approach. And so underwriting with Guardian, if it's not done correctly, can be fairly difficult for agents, which we'll dive into a little bit later as well.
What I would say here is while they're not anti infinite banking, they're for sure not supporting it or even necessarily even showing up to any of these events. It's partly because they're super, super big and partly because they're pretty strict when it comes to making sure that they're clean from a standpoint. Because as an insurance company, as you can probably imagine, you want to be very careful to cover your butt on any one selling strategy. And so, like you said, their products are great. They're very, very big. And so we'll talk at the very end, my thoughts around that, around viewing this company from a standpoint of how you should approach doing infinite banking with them. But overall, this is pretty normal.
Yeah, absolutely. Well, jumping into products. So the next section is going to be a little bit product heavy. The best product, in our opinion, for infinite banking style is going to be their Whole Life 95 product. Guardian is pretty unique. They've got a lot of whole life products and they all do different things, but high early cash value, it's going to be right here in the Whole Life 95.
Yeah, and just real quick on the cash flow policy design, this is every year you're funding out of pocket, and then the front load policy design is you're putting more money up front, and then every year after that is similar policies. Obviously, there's a lot of different ways to do policy designs, but these are two policy designs that we want to stay consistent in this series for you to be able to compare at that age group, this funding mechanism, how they resonate.
Yeah, absolutely. Thank you, Caleb, for jumping in there. And so when we look at this from a cash value perspective, right, early access is pretty important to most of our clients. So we're looking at somewhere between 80 to 88% cash value year one for a cash flow style policy. Understanding rating, age, policy structure, flexibility that you want, all these things play into that number. So as a range, 80 to 88% is fairly reasonable in my opinion. One cool thing about their product is it's highly flexible for funding, but we generally recommend 7 to 15 years of funding, depending upon your age. And the reason for it is the best way to maximum fund a whole life policy with Guardian is to use a certain term rider called Q term. This rider actually does increase in cost every year it's on the policy. So we don't want to keep it on the policy too long as it starts to affect the long-term coverage. So 7 to 15 years is really the best optimal design in most cases. Jumping down to long-term internal rate of growth, I would say this carrier's growth is average among its peers. So the internal rate of return tops around 3.7 to 4.1 given current dividends. And what we're going to do now, so we can just kind of back up what we're saying verbally with some actual numbers, I'm going to pull up an illustration that we can look into, and I'll kind of walk through some of the nuances to how it works. All right, so a lot of numbers on your screen. A lot of people get whiplash when I first start this. But what I want to highlight for you first is this is a 40-year-old male, preferred non-tobacco. So it's a one step above standard, putting in $50,000 a year into a cash flow design. The way I've built this is to have $50,000 a year paid for 20 years. And then after, we've dropped to $0 in premium. So what's happening here is a premium offset. A policy itself is just being paid for by the policy. So it's a really cool feature we can turn on or off at some point during the policy. When we look at the cash value, so first year you put in 50, net cash value at the end of the first year is going to be 42,000. And actually, excuse me, I made a mistake. Guardian is very unique in that their illustrations are showing the values, but they don't include a dividend in the end of the first year. So think of these as the guaranteed interest is paid. The dividend is not in that first policy year. Year over year, that trend continues. So if we're doing an apples to apples comparison, what you're seeing in first year cash value on an illustration from Guardian versus Mass or Penn or Emeritus, any of these other companies, the numbers are inherently different. But over time, the averages out are still accurate. So keep that in mind. It's a little bit of a confusing part.
So Alden, just to summarize what you mentioned is you could just make the assumption that they're more conservative when it comes to illustrations because a lot of carriers are including the end of the year dividend and they're not, but it's just rolling into the next year. So they're almost like intentionally 1 year behind, but they still pay that end of the year dividend.
Yeah, and it's an interesting point as well because the dividend, although it's declared in the year that you're paying, at every carrier, you don't actually get the dividend until you pay your next premium. So we want to look at it from that perspective. Guardian's doing it right and everyone else is wrong, but I won't make that stance to the editing, the joke. But all right, looking at the policy design, it's very efficient on cash value. Early on, we get about 84% cash value in the first year. And year over year growth is very strong. So a lot of numbers again, but I'm going to look at 50,000 going in. We get to a point where the policy now has broken even, which is another metric that we look at for efficiency in 5 policy years. So this is phenomenal. The other metric that I like to look at is called the capitalization point. What that means is that at what point am I able to put in $1 and does that dollar increase in value inside the insurance contract in that year? Guardian is very quick off the gate here with this. So if we do the simple math, because they don't give us a number like some other carriers do. The difference between 42,000 and 92,000 is just over $50,000. So what this means is starting the very second year, you put in 50 grand and you have more than 50 grand available to you in cash value in that year. Every year after, that gap just continues. This speaks to Guardian's strength. High early cash value, very, very early on in the policy. They're very much leading the charge in this space for that specific metric. Now, there are a couple of nuances to this. I mentioned high early cash value early on. One thing that I mentioned before, Guardian does not do great at is long-term funding at these high-level premiums for one big reason. This policy is built with 1-year renewable term insurance. So year over year, the amount of term insurance that's needed on the contract is actually going down because our permanent insurance, because of paid up additions, which buys more death benefit, the permanent insurance amount is going up. So year over year, we have a term coming down, permanent going up, which makes the death benefit, as you can see on the right-hand side, it is level. It stays at that $3 million mark throughout the policy until the term drops off. So why does this affect you? Long-term funding at Guardian is not as efficient. Imagine for the moment that we want to continue to fund at 50 grand per year, starting at year 21 moving forward. I cannot do that with this policy because once the term drops off, I lose some ability to fund paid up additions. So Guardian is very much a niche carrier for us where we're doing short funds and a lot of premium upfront, which will be shown in a moment on the front load side.
Yeah, one thing I would just want to notice is the net death benefit is staying level for the 20 years. And I just think that goes back to the unique way that they're doing the annual term and how you're decreasing that over time. I think it's important for the series just to look at the year 20, the death benefit, cash value and all.
Perfect. So if we look at the net cash value after 20 years, about 1.47 million. And then that death benefit stays at that million, drops slightly, and then continues at $3 million plus moving forward. So if you're making notes, if you're trying to get to the comparison before we do it for you, then look at those two numbers, the 1.47 million and then that $3 million death benefit. All right. So jumping back over, now we're going to take a look at the strategy for front loading with Guardian. Right off the bat, if you were taking notes, you notice that in the last policy illustration, we got to around 84% cash value in that range between around 80 to 88%. When we front load with Guardian, because of how I can manipulate that term insurance, we can get closer to 85 to 93, sometimes closer to 94, 95% in certain circumstances. So this carrier is among the top when it comes to early cash value in the first year from a front load. Now, I will make a big caveat here. This insurance policy, the one I'm about to show you, I have it paid for 10 years instead of 20 like we've been doing for other videos. The big reason is with a front load, I have to buy so much insurance to justify putting in premium. And that term rider gets more expensive the longer it's on the policy that I have to do some, let's say, finagling within the policy to make it efficient. And so I have the term stopping after 10 years and we also stop funding at the same time.
So this is not a true apples to apples comparison.
This one is not. But when we do a carrier comparison of everything across the board, I'll build some apples to apples specific to this. If we did true apples to apples, forget about it. Guardian doesn't show off at all. So showing where they excel in this front load space. Average long-term growth, anytime we do a front load, your internal rate of return is going to be affected because we're buying more insurance. So 3.5, 4.1 is kind of where we land with current projections. Now, jumping over into the insurance illustration itself, this is a front-loaded illustration where we're putting in 100,000 the first year and then dropping to $50,000 a year through year 10. This is the optimal design, in my opinion, for Guardian front loads. Big reason is that cost of term insurance. And Guardian is a bit unique in that your ability to fund into the paid up additions rider is contingent on that term rider being on the policy. So once it falls off, you can't overfund up to 50 grand anymore. So we can imagine if I wanted to fund this for 20 years, instead of buying about 1.6 million of term insurance, in order for it to stay on the policy for 20 years, I needed to buy about $3.5 million. And that severely impacts the performance of the policy because it's so expensive. So that's why this is the one carrier we're not doing true apples to apples. But when we do a full showcase of all of them, I'll bring in some apples to apples so you can see where it excels. High level cash value is very strong, 92% in the very first year. Death benefit is actually lower than the cash flow because of what I mentioned. I don't have to buy as much term here because I don't need to fund this policy for as long. A little confusing, a little nuanced, but we have a situation where we're building the policy right to maximize the right thing for the right amount of time. In this instance, high cash value, best we could do first year, funding for a short time frame. So what we see from a break evens perspective, guys, this almost breaks even. It's like $250 breaking even in 3 years. So they're very strong in front loads, very strong. And this, remember, this is also including that this is the beginning of the year snapshot on the illustration, not the end of year. So in theory, you could be kind of breaking even if you compared it to all the other insurance carriers and the way that they illustrate. Going out here, technical break even is year 4 for this illustration. And then the capitalization point, that other metric that we've been tracking, is how quickly we have more money than what we put in that year. And that happens in year 2. So the jump between the first year and the second year is just over $53,000. So we have a very efficient out of the gate policy. So Caleb, any thoughts here? This isn't apples to apples, so we won't be pulling numbers off of year 20, but any thoughts before we jump into the next segment?
No, I mean, it's not every carrier thrives with early cash value and still average to above average long-term growth. And what I hear you saying is this could be very competitive if you look at a shorter pay. Obviously, when it comes to the power of infinite banking and the power of just wanting to cycle as much money through your system, you could see this as a negative of like working with a carrier that just gives you better flexibility to fund long term. It could be a really valuable thing if you understand the power of cash flow and continuing to put that through your system. So that's just a thought that I had, but overall, especially with Guardian, they're being conservative in their illustrations, and their illustrations are very, very competitive. Imagine if they actually illustrated the way other carriers illustrate, it would even look better.
And now that we've looked at some policy designs, I'm going to give you guys just some insight into how you actually use that cash value from the carrier, so the access. Okay. So this, like many of the carriers that we work with, we can get access to a fair degree of cash value fairly quickly, around 30 days from funding. Now, a little nuance for the agents. You cannot illustrate a policy loan in the first year, but it is possible. It's just a nuance for their software to be aware of. They are a direct recognition carrier, but that direct recognition guarantees a certain fixed interest rate. So this is a really unique aspect of direct recognition. So what this is saying is for the first 10 years, they say no matter what the interest rates are doing, right now prime rate's close to 7, maybe 7.5, that interest rate from Guardian is not going to change. They're saying you can borrow at 5% every single time. It does affect the dividend. But like we said when we did our review on Penn Mutual, if you've seen that yet, the dividend could be adjusted up or it could be adjusted down. It's all dependent upon the external interest rate in the economy. Once we get to year 11, we have some options. So I mentioned early on that Guardian is direct recognition, but starting in year 11 moving forward on most of their whole life products, you have the ability to choose a variable rate or to maintain a fixed rate for that time moving forward to maintain direct recognition. And when you actually want to pull a loan, that can be done actually through the portal online to Guardian. The interesting thing is that depending upon your policy, its cash values, the amount that you can pull through the portal is going to vary. So we don't have a hard and fast number here. But for anything larger, and I'll use that in quotations, you do still need to go through your agent or contact the carrier directly. And that often requires a verification in the form of a signature, just like with other insurance carriers that we work with. The last thing, and this is unique to Guardian, guys, is interest and how they handle it. Most of the carriers that we work with have a daily accrual interest rate, meaning that that interest can be tracked daily. Every time you log into your portal, you'll see that uptick in the interest that you're being charged. Guardian is a little bit unique. Guardian says, okay, you pulling out a $100,000 loan, our rate is guaranteed 5%. we're going to charge that interest today. So what that means is when you log into your portal, you're going to see all the interest that's due for that year due in your portal, because the assumption that they're making is that this loan is going to be out for a long time. So they want that to be clear within the policy. Now, to be fair, if you take a loan out and you pay it back in 6 months, they're going to credit you back the charged interest. So you're not losing in any sense of the term. It's just a little bit less clear to policy owners when they do pull policy loans. Caleb, do you have any thoughts or clarifications you want to throw in?
All right, no, I have nothing to add here. Alden, I think you explained it super well, and so we can move on.
All right, guys. So coming into PUA flexibility, this is one of my favorite slides. One of the cool things with Guardian is they do have a very flexible rider, but in one particular way, they are setting themselves apart from the rest of the insurance industry. They don't have what's called a backfill option, also known as a catch-up provision in their paid-up additions rider. So what this means in layman's terms is at some carriers, if we're not able to put all of the money into the paid-up additions rider in 1 year, the next year, you can fill up the rider for that year and backfill a certain amount to the previous year. So you're catching up the premium that you missed for that other year. Guardian doesn't allow that. We don't have any option for that. However, we do have some very strong paid up additions flexibility when we're using a certain Q term insurance rider. So while this rider is on the policy, you're allowed to contribute up to 10 times the base premium up to the MEC limit into paid up additions, accelerating what's called the buyout of that term insurance. Remember back the illustrations we looked at. Term insurance, if we have a lot of it, it slows the growth. The more pieces we buy, the quicker we remove that term insurance. And so over time, you have a lot of flexibility between the minimum and the maximum to continue to fund and pump money into this. But long term, the term is going to go away, or we're going to drop it off on purpose. Once there is no more Q term on the policy, Guardian guarantees basically 3 times the base premium in the first 10 years of additional paid up additions. So if your base is 5, you can do an extra 15 in PUA when there's no Q term. That's why we use it. We can get more PUA in there. But year 11 moving beyond, they limit you to a 1-to-1. So if your base is 5, you can only put in an extra 5 premium. This is another reason why long-term funding with Guardian just doesn't make as much sense. But early funding, high cash value, first 10 years is very, very strong. All right, guys. So just some other things to note that I found interesting that you might as well is Guardian is really unique when it comes to their long-term care and disability income. Guardian has a very large percentage of their business coming from selling disability income insurance to white-collar professionals. So think doctors, attorneys, lawyers, et cetera. And so in that kind of a structure, we have the expertise, let's say, of the insurance company. And what they've done is they've given us the ability to add disability income insurance riders to all of their whole life products. So imagine we have an insurance product, right, that provides cash value, death benefit. If you get disabled, the premium gets covered for you and they pay you. And also there's long-term care benefit. That's currently a trifecta or however many fecta that's unheard of in the insurance industry to my knowledge. So please someone correct me in the comments, but this is really, really cool. Long-term care, DI, whole life, cash value, death benefit, the whole 9 yards, all wrapped into one policy. Very, very cool.
That's a big benefit, especially when you're doing holistic planning. Long-term care combined with insurance can be a really attractive offering because some people don't love the idea of spending premiums on long-term care. If they don't use it, they almost lose it. And the way around that is to incorporate it into some type of life insurance chassis to know that if you don't use it, you still have the death benefit that will get paid to the next generation. And so that is an area that Guardian thrives, is if you want to do this type of planning, Guardian is for sure at the top, if not near the top of the list when we're looking with our clients.
Yeah, absolutely. On another aspect of just a cool thing when it comes to this carrier is that one of their waiver premium riders. So if you become disabled, the premium can be waived. So the insurance company effectively pays it for you. Most carriers do that just for the minimum required premium. Guardian gives you the option to cover also scheduled paid up additions. So one of only 2 carriers that I know of in the industry that allows for paid up additions to be waived and paid for you if you become disabled. Now, before anybody gets excited, it costs and it can be expensive. But that is something that Guardian is able to do, which is quite unique to the industry as well. One final thought on Guardian from a coverage perspective is some carriers can't work in New York. Guardian can. So New York cases, Guardian is one of our premier carriers for that purpose when it fits the design metrics that we're looking for. All right. We're going to try to wrap this up and land the plane here in just a couple moments, but we'll start with the advantages. So what are some good reasons to work with Guardian before we work into the considerations or the cons? So one, The big one in the middle is major mutuals. The one of the big four, the four largest insurance carriers that are mutually owned in the United States. Some would consider that a big pro. You may see it as a con for some of the reasons Caleb mentioned earlier. On the other side, they've got a great performance history, right? 155 years of paying dividends. When it comes to the design, strong early cash value. Guys, this is where they excel. Cases we take to Guardian almost always have a focus on early cash value accumulation from a front load perspective. We do also want to couple that with short funding in most circumstances. Another aspect of this is fixed loan rates. Knowing exactly what your cost of borrowing is every time you go to borrow can be pretty powerful, especially if you have long-term loans for real estate investors, syndication, business owners, whatever. That ability to know your cost of borrowing can be pretty powerful. All right, so this next one is Guardian Wellbeing Rider. Now, we did not cover this in detail. This just came out earlier this year, but in essence, Guardian will reward you for being healthy if you agree to submit some aspect of your Apple Watch, Fitbit, etc., data and activity to Guardian to verify your activity level. So it's kind of cool. You can earn extra dividends if you're a very healthy person. Not available in all 50 states yet because California and New York are difficult, but it's still being rolled out, which is kind of cool. This one, I want to say with a caveat, strong paid up additions payment flexibility while the Q term is on policy. Once it's off, you're quite limited. And this is the last one we just covered as well. Disability income and long-term care acceleration riders are available to any whole life product if you qualify, which is pretty cool. So the big cons, when it comes to working with Guardian, some considerations you need to keep in mind is IBC style approval can get a little difficult. They're a big carrier. They're very traditionally minded. And because of that, getting policies designed this way, the way we build them, approved, takes a little bit of finesse. Long-term performance with Guardian can lag behind competitors. The two big reasons is that Q term I mentioned. It's a big asset early on. It's not so helpful long-term, and you can't fund it at a high level as long. Because of that, we have lagging performance. There is no backfill ability with this carrier. So that's a big con for some people. And then, as we've mentioned very many times in this presentation, Q term usage has some big impact to policy performance. So Caleb, before I jump into the next section here as we land the plane, any additional thoughts?
Yeah, I think when it comes to Guardian, they're a big company. They're one of the four major mutuals. And so if that's a big deal for somebody, and for many people that is, like, I want to work with a carrier that I can get early cash value. That's like, I just like the fact that it's one of the biggest in the country. Guardian checks all those boxes and more. I do think some of the lack of flexibility in PUA, I know that was an advantage in some cases, but long term, it's definitely not an advantage. The other thing that I would just point out is there's pros and cons with being big. We have great relationships with our Guardian partners, the people that help us right with this, but we don't know the CEO, we don't know the top underwriter, and that's kind of obvious because they're much bigger. And so while some people may know the CEO, they're bigger, and as a result, even the IBC policy approvals we've found can be a little bit more challenging because they're big. You just have to go through their processes, and from a communication standpoint, that can create some friction at times. So overall, I'm being nitpicky at this point. They're a phenomenal company, and it's really cool that such a big company that has such strong financials also allow you to max fund and overfund policies like this. And overall, I think this is a really good snapshot of the company as a whole and the pros and cons.
So to kind of land the plane, I know there are actually a lot of advisors that watch our channel as well. I used to be one of them before I became an employee of BetterWealth. And so from a compensation perspective, in the industry, Guardian is seen as having very low compensation as an industry average. However, it's made up by long-term better payouts and renewals. So continual commissions on additional premiums long-term. Tracking of commissions actually can be a little bit cumbersome, even though it is such a large financial institution because of how some things are broken down. So not a con, just something to be aware of. You're definitely in it for the long haul from a commissions perspective with this carrier. Agent access to resources and support at Guardian, in my opinion, is excellent. Even on the side where I don't work within the insurance company as a career agent, because they are a career agent system. As a broker, I still have access to everything I would need to do what I need to do for my clients. Advanced planning support at Guardian is very strong. Additional resources are very strong. So from that perspective, they get an A+ in my book. Now, product complexity, and this is really, guys, this is just because they've got a lot of whole life policies and they have Q term, and they have different things you can add to policies like DI and long-term care, and they all affect each other. They're fairly complex. So I rate them about 7 out of 10 for the consumer complexity. if you're walking your client through all those different nuances to find the best solution for them. And then to give a final feather in their cap, their illustration software is based on the same fundamental framework as Penn Mutual. Both carriers, very, very clean illustration software that I really enjoy working with. The conclusion. So, Guardian, what is the conclusion here? In essence, Guardian, they're ideal for short pays. They have an incredible product that allows you to get a lot of cash into that policy very, very quickly. And I would consider them a premier white collar insurance carrier. So they're strong on the short pay, and the cash flow long term is not as good. It lags behind performance, but the product design and approval itself can be a little bit difficult if you don't navigate it correctly. So, all said, I think Guardian's a phenomenal carrier. We like doing a lot of business with them. But to step back for a moment away from all the products that we're talking about, all the carriers that we're talking about, the product and its design and your understanding are what matters most. The carrier choice among the top mutuals that we're reviewing is secondary. So I quote myself here for a reason, and Caleb makes fun of me for it. This is really, really big to me, guys, because when we're in a situation where we're illustrating against other carriers and throwing out, oh, I've got a dividend rate of 6.1 and oh, you're only a 5.7. Who cares? If you don't understand the product and it doesn't do what you want it to do, I don't care if I get a 14% dividend or a 2% dividend, right? It's the product and how it functions is what matters. Caleb, take it away with just next steps of how people can get connected.
I would say if you're watching this series and you have a life insurance policy that you would like us to review, we would love to do that. We have a link down below. We'll take a look at your policy and see if you're on the right track or if there's things that could be improved with what you're currently doing. And then if you're watching this series and want an infinite banking style policy or want to talk to someone to see if it makes sense, we would love to serve you and help you through that process. We also have a link down for you below. And then the other big thing is if you find this content valuable, if you've been watching us on YouTube and you're not subscribed, my ask would be please hit the subscribe button. And if you want to continue to follow this series and other videos that we have in the future, make sure to go hit that notification bell. And then every time you comment, you share, you like our videos, it just tells Google and YouTube like, hey, this content is valuable. And so from the bottom of our heart, we're grateful and we read every comment. And I want you to know that if there's questions that you have or videos that you want us to do, one of the best ways to get our attention is putting that in the comments below. And a lot of our video ideas come from you making comments.
Absolutely. Well, to land the plane here, guys, I've had a lot of fun. I really enjoyed the process of researching all these carriers, the ones that we work with, and some ones that we don't that you'll be seeing as well. So continue to follow us. Thanks so much for your time. See you on the other side.
If you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company COMDEX scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment.